Does your characterization of a person affect how you deal with that person? Most likely the answer is yes. Well, the same would apply in business, especially in the context of transfer pricing. Being aware of the nature of business determines how you would characterize this entity, and accordingly characterizing the entity would affect how you would be treating this entity from a transfer pricing perspective. So, what do we mean by entity characterization in transfer pricing? That's what we are going to discuss in this video. Hello everyone and welcome to the TaxGate. Hit the subscribe button and let's get started. Well, entity characterization in brief means the process of determining the entity type in terms of how the economic risks and profits are distributed in a controlled transaction at the level of the industry where this company operates. Let's simplify. In theory, and from economic perspective, higher the risk, higher the return. The same would apply in transfer pricing, which means that the transacting entity who takes relatively more risk in any business arrangement would be expected to have relatively higher returns from a transfer pricing perspective. And that's why it is very important to define the risk profile of the transacting parties precisely, as transfer pricing compensation and return would be determined accordingly, and that is the job of the entity characterization. So, we would say that entity characterization enables entities in a group to be classified, based on each entity's functions, assets and risks, from simpler entities to the more complex one. Well, so here would be the question on how this is done. And here we should importantly highlight that the result of the functional analysis review is the base of entity characterization process, which mainly summarized the transaction background, including the functions performed and the assets employed and the risks associated, as well, and then use such as reference to have a meaningful comparison of the price or level of income of the entity in a controlled transaction against the price or level of return from a similar independent transaction. Well, so, why entity characterization? Why it is important? And here we would say that entity characterization is not just a formality in transfer pricing documentation. It drives the selection of the transfer pricing method, the identification of comparable companies, and the results of benchmarking analysis. By determining the accurate characteristics of a business, the expected level of price or return by the entity can be known and the selection of reliable comparable can be made. You cannot compare the price or level of return that a full-fledged manufacturer would earn with that of a toll manufacturer. Good. Now let's discuss the examples or types of entity characterization. So, some of the most commonly used entity characterizations based on the nature of the business activities are as follows. Manufacturing entities, distributor entities, and also service provider entities. And now let's briefly go through each one of them. Let's start with the manufacturing entities. Many groups outsource their manufacturing operations, particularly in low-cost territories, to enhance profit margins and to be price competitive, and here the group may decide that it would be more effective to set up their own manufacturing subsidiary, to be in control over the manufacturing process and to protect their intellectual property. And here the job of the functional analysis is to identify different types of manufacturing entities as follows. Let's start with the toll manufacturers' entities. Toll manufacturers essentially perform very limited manufacturing functions to the principal without taking title to the raw materials or the final products, and that's why toll manufacturers would be the lowest risk entities. Also, we would have another type here, which is the contract manufacturers. Contract manufacturers would be a little bit similar to the toll manufacturers, as they are also performing a limited manufacturing functions and produce the product for the principal. However, contract manufacturer would own the plant and the machinery and also would employ the needed skilled labor force. Also, they would take title to the raw materials and the finished products, and normally the principal would guarantee to buy all the manufactured goods provided that it meets the specified quality and quantity. However, it will not own any of the design-related intellectual property. Well, and now with the last type here under the manufacturing entities, which is the fully fledged manufacturers. A fully fledged manufacturer perform all the manufacturing functions, including the research and development, also product planning, raw materials sourcing, manufacturing process, quality control, distribution and logistics, and after-sale functions, also owning any of the design-related intellectual property and of course bearing all associated risks. Well, those were the main types of the manufacturing entities, and now let's move to the next type here, which is the distributor entities. Sales functions, activities, and the related level of risk can vary from entity to another. At one, for example, the entity would take title to the stock risk or licensing a brand or other intangibles. At the other, an entity may provide sales support, research the market and facilitate logistics without entering into customer contracts or taking title to the products. Well, so one of the types of distributor entities is the limited risk distributors. And here limited risk distributor is a company that buys goods and markets them to customers. So, it is performing buy and sell functions with limited risks. The risks such as the one related to inventory and debtors will be effectively controlled and covered by the principal. For instance, the obsolete stock will be bought back, bad debts will be reimbursed. Also, we would highlight that limited risk distributors would sometimes contribute to the marketing activities without developing a significant marketing intangibles. Well, another type to be highlighted here, which is the commission agents. The commission agents do not normally purchase products and resell them to the customer. They mainly perform as a sales representatives and receive commission based on sales made to the customers without taking title to the products and accordingly bear limited risks. Also being agents, they are responsible for interaction with the customers and facilitating sales. However, the terms of the sale and the contract for sale itself are agreed and concluded by the principal. Also, here one of the important points to be highlighted, which is one of the main differences between a distributor and agent, that while a distributor reports revenue as the amount of the product sold to customers, the agent generally reports income against the amount of the received commission. Good. Now with the last type here under the distributor entities, which is the full-fledged distributors. Full-fledged distributors perform all the sales and distribution functions from marketing to inventory management and accordingly bear all associated risks. The full-fledged distributor has the potential for achieving a significant profit due to their engagement in various operational activities, including marketing, distribution, and off-course sales. And here it is important to highlight that market fluctuations and changes in various factors can significantly impact the full-fledged distributor's level of profitability. Well, that also was for the main types of the distributor entities, and now let's move to the last type today, which is the service provider entities. Let's start with the full-fledged service providers. Full-fledged service providers normally perform all the service functions, including research and development and how the services should be typically done, along with the related commercial aspects and also the related warranty, and bear all associated risks. Well, now with the final type today. The routine service providers. Routine service providers normally perform routine support service as ordered by their principal and bear limited risks. Those functions would be performed centrally for the purpose of better and efficient cost management, and normally they would include back-office functions such as human resources, IT, finance and legal services, and here these activities are necessary but not a business differentiator, and that's why they fall under the characteristics of being a routine support services. Good. That was a quick introduction to the entity characterization in transfer pricing and why it is important. Like and subscribe if you would like to see more videos, and thanks for watching TaxGate.